Yes. Okay. Money market and capital market. So money market less than 1 year, capital market more than 1 year, right? So what happens here is that first you have to learn about the instruments, right? What instruments are actually traded here? What are all the instruments? So in banks it is loans, right? In banks it is loans. What about this? So you have money market instruments. What are all the money market instruments? So first, online people, audible. Yes, no. Yes. Money market instruments, first one. Government. What all instruments does government use in order to borrow money for short term? Right? 2. Corporates. 3. Banks. 3. Banks. What do they use to borrow for short term? Government. To borrow for short term, what instrument does it use? What instrument does it use? It uses an instrument called T-bill. Treasury bill. Yes or no? So, what is it? It is a part of money market. Why is it money market? It borrows for less than 365 days. So, T-bills come in 3 variations. Which are the 3 variations? 91 days, 182 days, and 364 days. On the 368 days. So, T-bills come in 3 variations: 91, 182, and 364 days. And it also issues what are known as CMBs, cash management bills. What are these cash management bills? Any instrument issued by the government for a tenure less than 91 days. So the tenure can be 90 days, it can be 85 days, it can be 40 days, 27 days, any day, any number of days. What are they known as? CMBs. Done. Clear? So government uses these. What about corporate sector? What about corporate sector? How do they borrow? Any idea? How do they borrow? Yes? No? They borrow through what are known as commercial bills, CVs, commercial papers. This is for short term borrowing. Commercial bills, commercial papers. What about banks? Companies. Companies, merchants, they use these. Short term, less than 1 year. Okay. What about banks? What about banks? What do banks borrow? Tell me. How do banks borrow? Where do they borrow from? RBI से borrow करते हैं. What route they follow? How do they borrow from RBI? Repo, reverse repo. Very good. Repo, reverse repo, MSF. Don't you think these are all instruments for borrowing from the RBI for short term? What is repo?
I know what is repo, what is reverse. What is called like some doing something.
What will? This one.
What is it called as? Repo is the interest rate.
No. It is an instrument, na? Repo instrument. See, repo rate is the interest rate. When I say just repo, it's like a agreement, na? Remember, it is a repurchase agreement I had told you. Repo, full form is repurchase agreement. What is that agreement? It's a what? It's an instrument. So you have repo, reverse repo, inverse repo. Right? Now, banks also borrow in other ways. Not only this, from RBI it borrows. Apart from RBI, where does it borrow from? It also borrows from other banks. It borrows only for one day sometimes. Shares, debt, debentures, we will come to that. Sir. We will come to that. Now I am feeling like I am teaching. Honestly. Right? Because, sitting at one place, that becomes really difficult. So you are thinking, sir, we will be sitting at one place only. Okay. The banks, they also borrow other way from other banks. How do they borrow? What instrument? It is known as call money and notice money. Call and notice. Call money and notice money. So what is this call money, notice money? If the bank is borrowing from other bank for just one day, it is called call money. Only one day. Now, one bank borrows from another bank for just one day. Yes, obviously, on a daily basis. Consistent basis. You might ask, sir, why do they borrow? Just for one day, what will they get? Remember, see, they have to maintain that balance of what CRR, SLR, quota they have to maintain. If they don't maintain, fine will be applied. Yes or no? So, to maintain that, sometimes there will be a mismatch. Right? Cash outflow ज़्यादा हो गया, कम पैसा बच गया आज. Just for adjustment. How adjustment? Adjustment how?
Someone's telling me they give me some money.
No. Basically like that. However, this will attract an interest rate. When they borrow from other bank, they'll not give it for free. Right? So this is for one night. What is this for? Notice money. More than one night. However, up to 14 days. Up to 14 days. वही से 90 days बोल दिया, आगे जाके 180 days बोल दो. Okay. Now, this is notice money. Call money, notice money. Done. एक और है. It can borrow. It can take the money from other people as well. High net worth individuals. Right? For less than 1 year. It will take it as a deposit. And this is known as CD. Certificate of Deposit. CD. Certificate of Deposits. What are all these? Money market instruments. One of the major thing about the money market instruments is that most of them are based on zero coupon rate. Zero coupon rate. No. Almost all of them will be working on zero coupon rate. Or we also call it as discount at face value. Zero coupon rate or discount at face value. Both mean the same thing. It applies to all of them. It applies to all of them. That is how they work. So what is this thing? Discount at face value. So what does this mean? Very simple thing. This is a piece of paper. This is U. This is U. Okay. So this piece of paper, let's call it what this is your T. Who is issuing this T-bill? Government. Government is issuing the T-bill. Now, you buy this T-bill and give money. Right? Rupees 100 you are supposed to pay because the face value of T-bill is rupees 100. How much is printed on this? Rupees 100. And it does not mention any interest rate. Interest rate mentioned like that. Because it does not mention any interest rate, it is known as what? Zero coupon bond. Right? Now, rupees 100 is mentioned on what? On the T-bill. This is the face value. The tenure of this T-bill is 182 days. What does this mean? What does this mean? Whosoever has purchased this bill, right? After 182 days, if he returns this T-bill, he will get how much rupees? 100 rupees. Right? He will get how many rupees? 100 rupees. Sir, but he gave also 100 rupees. No. He gave 97 rupees. That is why it is known as discount at face value. He purchased at 97 rupees. Right? 97 rupees is what? Discount at face value. What is the face value? 100. He purchased at 97 rupees, which is a discount. Discount at face value. Is interest rate mentioned? No. That is why it is zero coupon bond. After 182 days, he has to return this bill. How much will he get? 100 rupees. How much gain did he make? That itself is like interest. Clear? Understood? This is the interest. Is
that fixed or is it
Is
that interest fixed or is it varying?
No, it keeps varying. It keeps varying.
Like one.
This discount keeps varying. Okay. Now, very simple. This is known as the price. 3 rupees which you gained is known as the yield. That's all. This is known as the price, this is known as the yield. Yield is nothing but the gain of it. Clear?
It is so marginal, why people buy this?
Sir, for 100 rupees you are getting 3 rupees for 6 months.
So like compared to interest rate, it's better. Interest rate.
No. It completely depends, no? It completely depends. Bank man. If you put the money in the bank, how much do you earn in the year? Per annum interest rate, how much is it? Online people, you tell me. How much? Which bank, sir? Any bank. You are getting 2.5%. Go check it. Savings account. I am talking about savings account.
Maximum.
If you are putting in a fixed account, right? Then you are going to get over 6%. But how long are you giving the money here? 6 months. It is less than a year. That's why interest rate will be less. Done. This is how the money market instruments work.
If you give money for loan for short period of time, interest rates will be more.
No. That is unorganized sector. Outside. Those people who have bullet white clothes, there it is more. Right. Okay. So Sonali 2.57%. She's more precise. She's like 2.57%. So done. Got it? You got the concept? Okay. Money market instruments work like this. However, Next, we are going to see capital market. What is capital market? What is capital market? Lending and borrowing happens for what? More than 1 year. Capital market instruments. What are all there in capital market instruments? Can we sell loans or capital market instruments? Yes, sir. It's an instrument. You can borrow for more than 1 year, no? Loans. 2. Dated securities. What are dated security? GSEC. Yes. Borrowed for more than 1 year. 3. Shares.
Shares will come in.
Shares. Capital market instrument. So why? See, maybe you are buying and selling, but once a share is created, it is going to be there for long term, no? Yes or no? From the company's perspective. 4. Bonds, debentures. Bonds, debentures. Done. 5. Municipal bonds. And inflation index bonds. Inflation index bonds. 1, 2, 4, 5, 6. They all work on what basis? They work on interest rate.
Corporation bills and papers. That time municipal bonds. What is the difference between papers and bonds?
I'll come there. So, these 5 instruments work on what? Interest rate basis. What about this one? Shares. What does it work on? What basis? Dividend. It works on dividend basis. Yes. Now, loans we have already seen. Where was this? Banking sector. Dated securities. This is related to government. Shares. It's related to both government and private. So, does government release shares? PSUs, public sector undertakings, they release shares. Bonds, debentures. It is generally the corporate sector. Corporate sector, as well as some PSUs also issue bonds, right? So it is also the government. Government also uses this. Municipal bonds, it is only municipalities. It is only municipalities. And inflation index bonds, government. Done. Now, we'll see. Dated securities you already know, right? Dated securities you already know. So what are dated securities? The government issuing the bonds, right, for more than 1 year tenure, on which interest will be paid, and they come in various tenures. So they come in sometimes 3 years tenure, sometimes 5 year tenures, 10 year tenure. Done. All these, work on interest rate, right? However, we generally do not refer it to as interest rate. What do we refer it to as? Remember, what do we call it rather than interest rate? In this case, we clearly call it as interest rate. But in these cases, what do we call it as? We call it as yields. Remember earlier also, I spoke about yield, right? That interest rate is called yield. So basically, whenever you have bonds or any debt instrument, so basically these are what? Debt instruments or not? What is a debt instrument? You borrow and you have to pay back. Share is not a debt instrument. Share is not a debt instrument. So share is what? What sort of instrument is it? Equity instrument. Look at this. Here. Debt and equity. Debt instruments क्या क्या है? Out of the 6 we have now, right? How many are debt? 5 are debt. 1 is equity. Agree? Now, go back to primary, right? Primary instruments, primary market instruments. Usme, sorry, rather than primary market, money market instruments. Look at the money market instruments. Usme, tell me, are there any equity instruments there? Or are they all debt instruments? All are debt instruments. So, in debt market, what do we have? All that we have mentioned in our what? Money market. It includes all those instruments which are there in your what? Capital market, except for shares. Shares will be where? Here. That's all, very simple. It's just the classification. Yes. Now, we are here. Bonds, debentures, municipal bonds, inflation index bonds. And then we have to look at what? Price and yield. What does it mean? Price and yield, it is very, very simple for you to understand. What is price and yield? Prices. So same example we will take. It's you here. It's you here. And there is a bond.
So what? So you mentioned all of the prices yields. Having capital itself.
They are not yields. They are financial instruments which can be put under debt. They are all debt instruments.
Instruments will be having yield.
They will provide yield. Yes. Yes. So we have the bonds.
So we are saying interest rate is also, and we are saying yield also.
It is the same thing. See, basically, when you take a loan, what do you get? When you pay a loan, what are you paying? You pay interest rate. When you buy a bond, right, what do you get? You get interest rate itself. But in case of a bond, instead of calling it as interest rate, we call it as yield. That's all. Itna yield. That's all. From the bond's perspective, buyer's perspective, it is a yield. Now, why do we call it yield specifically? Because it is variable. It keeps changing. I will tell you why it changes also. Interest rate will be same. Yield changes. How does it change? We'll come to that. Okay. So, see, they don't name these things haphazardly. There's a particular reason as to why they name it like that. Okay. Abhi bond hai. Bond ka face value hai, let's suppose ₹100. Tenure is 2 years. You purchased it. Where did you buy it from? This bond you can purchase from, it can be a government bond or a private bond or a corporate sector bond. From anyone, you have purchased it for ₹100. 2 years later, in the bond, it will be clearly mentioned, this is the interest rate I am going to pay. How much interest rate? It is going to mention, let's say 6% interest rate per annum. On the bond. This is fixed. This is fixed. 6% interest rate I am going to pay. Done. Now, this person who has this bond, right? After 1 year, he will get how much? 6 rupees he is going to get after 1 year. Second year also, he gets 6 rupees. But because he returns the bond, what does he get? Plus rupees 100 as well. Why? Because principal.
So TVs we don't have more.
Huh?
TV
No, it is not mentioned.
what all is the interest mentioned?
Interest is mentioned only in the case of secondary market instruments. Sorry, your capital market instruments. Right? It is only for money market. In money market, how does it work? On what basis? It is working on the basis of zero coupon or discount at face value. Here, how is it working? Interest rate is mentioned.
So if it is 100 rupees, you have to pay 100 rupees then get.
You have to pay 100 rupees. No? There is no discount at face value. There is no discount at face value.
Discount at face value only.
Money market instruments. Money market instruments only. Here, no discount.
So this 6 rupees should be given every year.
Every year you are going to get.
Per annum.
Per annum. Huh?
Not like recurring.
No.
Like not as a whole after.
No. Every year you get paid. Okay. Now, here what? So this can be the case for any. So basically, we also use the term debenture. What it means is that bond is a term which was used in UK. Debenture is a term which was used in US. ठीक है? Now, India में क्या हुआ? India, what we did is initially when we took the term bond, we used it for government. Whenever government issues, we called it as bonds. Whenever private sector was issuing, we were calling it as what? Debenture. Later on, the private sector also started calling it bond. Now, there is not much difference between bond and debenture. These words are used interchangeably in India. However, one difference generally people can understand is that whenever you call it as bond, it is more secure. Debenture is generally less secure. Right? Less secure. What is less secure? If a small firm is issuing bonds, it is less secure. If a big firm, corporate sector or a government firm is issuing the bond, then what is it? It will be more secure. Done. So as of now, we don't have this classification. Government issues means bond, private sector issues means debenture. It's a classification.
Only bond.
We call it as only bonds. Right? You can use the term debentures as well. There is no problem. Okay, there is no clear-cut classification. Okay? Done. So don't get confused. Bond is in a debenture. Oh, debenture. I don't know what is debenture. Debenture means same. It was same as bond. Done. Next. We'll go further in this thing related to bonds. You are asking about yield, no? Your yield thing gets, clarified now. Say for example, what's your name? Rohit. You are the one who was speaking here. No, right? That's Rahul. Okay, Rohit. So what Rohit did is he purchased a bond by paying 100 rupees. He was expecting how much return? 6%. Correct? 6% after how many months? 12 months ke baad. 1 year later. This is the 1 year bond or 2 year bonds. So 2 year tenure. After 2 years, he can get this 100 rupees back. Now, if he waits for 2 years, he gets yield of how much? 12 rupees will be the yield. So 6% yield will be there for 2 years. Now, The problem is after 1 year or after 6 months, he's like, I want this 100 rupees. Done. He wants this 100 rupees. But if he takes this bond and goes to the government, ek marega. Hey, I told you after 1 year, get lost. Yes or no? Pakka. So it is not going to give. Now what to do? You have made an investment, but you want the money now. In bank it is easy. You have put the money, whenever you want you can withdraw. Here, what will you do? What will you do? You will tell the government, hey, pay less interest only, but take this phone. Discount to whom? Now, the thing is, Rohit will find Selva, who is ready to buy this bond. Is ready to buy. However, he will not pay you how much? 106 rupees because 6 months are already done. Correct? Yes or no? Now, how much will you pay? How much will you pay? You will say, no problem. In another, how many months? 9 months are already done. How many months are left? Another 15 months are left. Yes or no? So, 9 months are done. Another 15 months are left. After 15 months, I will get how much? 100 plus 12 rupees, basically. This much I will get, 112 I will get. But you will start saying, I will not give it for 100 for sure. Why? Because 6 months I have also waited, or 9 months I have waited. I have invested this month. So what you will say is, I will give it for 102 rupees. Yes or no? You will give it for 102 rupees or 103 rupees. So Rohit sells the same bond for 103 rupees. Clear? Because 9 months he had. Another 15 months fees for return will jaya. Now, 103 rupees you got, you are happy. Your work is done. Now, this is the price at which Selva bought it. Now, this is the price of the bond. What is the yield of the bond now? What is the yield of the bond? For Rohit it is 3 rupees. Now we don't consider Rohit. We consider only Selva. How much is the yield? 9 rupees. Now tell me, if the price of the bond increases. Now, simple thing. Suraj also comes. Suraj says he is ready to sell. At the same time, Suraj comes in. Suraj comes and says, hey, I also want this bond. Demand बढ़ गया. Now you will say you are ready to give it at 103. Now you will say, hey, you guys decide. Who will buy? He's like, I'll pay 103.5. He's like, I'll pay 104. He's like, I'll pay 104.5. Yes or no? Now, it will be sold at 104.5 to who? Suraj, not 103. The moment you sell it at 104.5, what is the price? Is 104.5. What is the yield? How much is the yield? What did you observe? As the price increases, yield drops. Yes or no? As the price increases, yield drops. So, price and yield are inversely proportional to each other. It is very much legal. And this happens in a market. Yes. No. This happens in a market. What market? Now comes the question. What market? Very simple. See, पूरा chapter यहीं पे खत्म. Now, for the first time when Rohit bought the bond, right? For the first time when Rohit bought the bond, whom did he buy it from? Government. For the first time he purchased. Freshly he purchased. It is primary market. After that, he sold it to whom? Selva. Or Suraj. Or Suraj sells it to, ma'am, what is your name? Vidya. To Vidya. Now, all these are where? Secondary markets. Done. Secondary term. Karnataka.
So what happens in a case if first person gets interest for 1 year and then later you know that also
He'll get 6 rupees. First year he got 6 rupees. He took it. Now next year he is going to sell. Right? Next year at what price he is going to sell? 100 plus. Whosoever is the buyer. You are the buyer. Seller. Seller. You are the buyer. What do you say? 6% you have already collected. How much is there? Another 6 rupees I am going to get probably in another 1 year. Right? So do one thing. Sell it for 102 rupees itself. Why 6 rupees you have already taken? No? I will not get 12 rupees anyway. Yes or no? 6 rupees you have already collected. Now you can sell it at 100 plus probably 2 rupees or 3 rupees. That's it. Why? Because 6 rupees is already taken by. Done. Done. Primary, secondary. Very simple.